But welcome. Thank you all for joining us. Hope you're enjoying the event so far. As they're getting settled in, I'll just introduce myself again. My name's Diana Farmer. I'm the Action Manager at CDP. I'm not Elizabeth Small, my dear colleague, who unfortunately couldn't be here today. So for those of you not familiar with CDP, we're an environmental nonprofit organization that built the first systemic link between financial information and environmental information. We now run the world's largest environmental disclosure system. We are supported by 680 investor signatories, representing 130 trillion in assets. And we also have about 282 supply chain members in our working with us through a membership program. And they're really pushing all this change that we need to see through their supply chains. So using over 6 trillion in purchasing power collectively. So I'm going to take a seat here, and there are a few key trends that I think we've noticed at CDP to set the scene here. So we are seeing an increasingly broad range of investors demanding high quality and actionable data. And in 2022, this year in particular, CDP actually saw an increase in interest across asset classes. And this has been, I think, a really interesting and exciting development. So we're seeing private market investors engage and request data. Banks are requesting and engaging companies in their lending portfolios, and fixed income debt investors as well, all requesting data alongside institutional investors that we're more used to working with. The second trend I would say is that investors and customers are taking a full value chain approach. So it's really becoming a need and a must for smaller organizations to partner with their customers and investors. They have to start measuring and reporting their performance on these topics. And the third is that regulation is increasing. We, I think, have heard that a few times today. We've all been mentioning the SEC, but climate metrics and other metrics have been integrated into mainstream financial reporting rules around the world and in other jurisdictions. So with these key trends, the coverage of all asset classes, that value chain approach, and increasing regulation, I think it's really vital to make reporting more effective and streamlined. I think all my guests here will agree with that. And with those trends, yeah, we want to talk a little bit more about how we're going to do that. So these fantastic panelists are going to help me explore the topic. I have Granville Martin, Head of Global Regulatory Outreach at the Value Reporting Foundation. David Madden, our Director of Sustainability and Policy and Regulatory Affairs at IFAC. Nate Hurst, Principal at C3 Strategies. Wow, you guys all sat in order here. That's wonderful. And then I have on virtual streaming Ann Simpson, the Global Head of Sustainability at Franklin Templeton. Hi, Ann.
Hi.
And last but not least, Randall Hopkins, Head of NASDAQ One Report and the Regional Head of Capital Markets. So welcome, everyone. Thank you for joining us. And we're going to start with you.
Because I'm not sitting in the right order.
And you're wearing colors. So, yeah, let's start with you to remind us maybe why ESG is so important to investors. And also if you could then speak to maybe the challenges and barriers, even if it is so important, what is standing in the way?
Well, first of all, thank you for having me, joining you virtually. I'm based in California, so to fly out to talk about climate change and things like that and then fly all the way back again didn't seem the best example to set. So I really appreciate being able to beam in from afar like something on Star Trek. But I think technology is helping all of us to stay involved and do a bit less traveling, which is a good thing. So why does it matter? I think really on the ESG debate, one of the problems we've had is that the acronym doesn't specifically refer to finance. I know I've said this before, but there's no F in ESG. And that means we think of it as a separate topic. And somehow our day job as investors producing risk-adjusted returns is all over here, and we've got to bring ESG and integrate it. But I think there's a better way to think about this. And this is very much how we approached it at CalPERS as an asset owner and how we're thinking about it at Franklin Templeton, which is if our duty is to produce risk-adjusted returns, for a start, that has a social purpose. Most of the money in the world comes from hard working people's savings, and they're investing in order to meet needs like retirement, healthcare, education. So this isn't a question of F for finance in competition with ESG, quite the reverse. What we're talking about is how do we ensure the sustainability of those risk-adjusted returns? We go back to old-fashioned economics. We know value comes from managing not one, but at least three forms of capital: financial capital, human capital, and natural capital. But our reporting regime is partial. And it's not just on issues like climate change. I remember a couple of years ago sitting down with Anne Sheehan and Cambria Allen and others with Jay Clayton, former chair of the SEC. We were saying, look at the data, 85% of the value in the S&P 500 is intangibles. 30 years ago, it was fixed assets. So there are these secular shifts in the economy around human capital we need to capture. Of course, the pandemic was a brutal reminder of the importance of that approach. But by thinking about these as three forms of capital, then the question is, how do we know that capital is being well managed, that risk is being taken care of, that opportunities are being followed? We're back to reporting. So I think the barriers at the end of the day are well expressed in that wonderful MIT paper called Aggregate Confusion. In other words, with the proliferation of effort, you've seen the enthusiasm, the need, the demand for this information, but we haven't had a clear set of global standards against which companies can report and which investors can use both in their stewardship work and in their capital allocation work. Now, we've got the opportunity of a generation now because the SEC has put forward excellent proposals on climate risk. We've got the Ifrs setting up the International Sustainability Standards Board. And into this, we've got an opportunity not just to have a set of parallel reports, and many companies have been doing that, but actually get it integrated. So my words of enthusiasm on this must reflect the landmark vote at Exxon just a couple of weeks ago, where investors, a majority of investors, supported a proposal which was not supported by management, I'm sad to say, but the proposal said an audited report at Exxon is needed on climate risk, which discusses the assumptions that are being made in the accounts. So for the first time at a big oil major, we've got the demand for this holistic form of reporting being put forward. So, the way forward is simple. If we're going to understand better the risk and the value, we've got to have this holistic approach to reporting. So I think, we're moving out of the let 1,000 flowers bloom approach and into something which is going to be far more disciplined and decision useful. And many on this panel have been working for years on getting us to that point. So we thank you.
Thank you so much, Anne. Yes, and I think a lot of what we'll touch on throughout the rest of our conversation here, but a very natural segue, of course, to the work of the Value Reporting Foundation and ISB's role in addressing some of those challenges that you mentioned. So, Granville, would you mind, and I'll frame it as not a challenge, but an opportunity, as we like to do. What's the opportunity for alignment towards a global baseline for sustainability disclosure standards?
Well, I think Anne teed it up very well. For those who don't know, and I don't blame you if you wouldn't, I represent the Value Reporting Foundation, and just to get into the weeds for a moment, we have been acquired by the International Financial Reporting Standards Foundation, which sets international accounting standards. And at the end of this month, that transaction will close, we will officially consolidate into the IFRS. Why did IFRS acquire us? To establish the International Sustainability Standards Board that Anne mentioned. And what the ISSB is charged with doing is creating globally applicable, consistent, and comparable sustainability disclosure standards that will be used in the 144 jurisdictions that currently apply international accounting standards. Those sustainability disclosure standards will also be used in the U.S., largely on a voluntary basis, but potentially pursuant to the SEC's climate rule, which we can talk more about later. And so the ISSB sustainability disclosure standards really are intended to apply to companies around the world to provide investors financially material sustainability information. And that's a key phrase, is these standards are intended to focus the information that they elicit on investors so that investors can use this to integrate and inform their investment and proxy voting decisions. The opportunity to have what amount to mandatory sustainability disclosure standards around the world this is a first. And the first standards have now been proposed. They haven't been issued, but on March 31st, the International Sustainability Standards Board issued what we call a general requirements sustainability disclosure standard, which sets the stage for the disclosure of all material sustainability risks and lays out really sort of an intellectual framework for companies to use, but also a second proposal or exposure draft on climate. And Anne referred to the fact that the ISSB has a climate proposal out, as does the SEC at the same time. This is actually an enormous opportunity to create a global baseline of consistent reporting on climate change, both at the ISSB level, which over time will be applied in dozens of countries and markets around the world, and in the US. And there's a really key question that the SEC asked in their release. And if you really want to know, it's question 189. And David has heard me say this a lot. And in question 189, the SEC asked, should we, the SEC, allow foreign private issuers, basically foreign companies that are listing in the United States, to use ISSB compliance, my employer, for their SEC climate change disclosures? This would be a really big deal were the SEC to say yes to this question. Because what it would do is it would institutionalize a common basis using the ISSB standards for companies listing into the United States to use the ISSB to meet their SEC compliance obligations. Of course, the US is the largest capital market in the world. So we feel like this would be a really meaningful step forward to establish these, what we call a global baseline. You can actually see it in concrete terms now. What does this actually mean? And we can talk a little bit more about that later, but what we did and what the SEC's rule does as well is leverage some existing voluntary frameworks, the SASB standards, which I actually joined a year and a half ago. I joined SASB, and the TCFD, the Task Force on Climate-Related Financial Disclosures. So I know I said a lot, we've got a lot of the panelists, and there's more to say, but the bottom line is we do have a real opportunity. If you represent organizations that have an interest in commenting to the SEC or the ISSB, we encourage you to do so. There's a lot that they need to hear, notably that you can use ISSB standards for SEC compliance. So I'll stop right there.
That's wonderful, yeah. And I think, we're also used to the multinational corporations being impacted by European regulations. It'd be nice to see the US have a bit of an influence there globally as well.
Well, that's sort of an irony, is it? I think the perception was 8 months ago that the US was sort of late to the party. It turned out that the SEC was the first to propose. And so they have moved actually more quickly than I think some people thought they might.
Can I just add a very quick point to that, which is to say the SEC sits on the monitoring board for the IFRS Foundation. So there's a structural relationship between the two systems. That's very important, and obviously a lot of dialogue. And I realize I'm here with David about to speak. But in brief, it is nothing new to allow IFRS reporting companies to present their reports and have them accepted by the SEC. This was agreed quite a few years ago. And basically, as there was convergence, harmony, improvements of understanding between the two systems, to say companies do not need to file a separate reconciliation from IFRS and into US GAAP. So this is, I don't want people to think there's some drama here. This is normal. The global capital markets, and we need systems that are interoperable. But it's an excellent development. So I know how we'll be answering question 189.
Well, I think we can maybe stick with standards for a moment and just turn to the accounting profession. And we will ask for audience Q&A. So if you're thinking of your questions, you're warned. We'll get through a few more here and then ask you all. So David, how has IFAC taken an active role in this emerging landscape, and how has the profession in general really fit into the ESG ecosystem?
So hello, everyone. Good to be here in person, if not odd to be here in person. Granville had to explain a little bit about the Value Reporting Foundation. I feel like I have to explain a little bit more about what IFAC is. So IFAC, the International Federation of Accountants, is an organization that represents professional accounting organizations around the world. So I think everyone here probably knows the AICPA in the United States. So believe it or not, there are 180 such organizations around the world in 135 jurisdictions. And that sums up, we counted them all because we're accountants, to something over 3 million professional accountants around the world. So that's the organization that I work for. I think Anne said we're looking for holistic reporting from companies and all kinds of company reporting. Financial reporting as well as sustainability-related reporting is obviously of interest to the accounting profession. We lend our expertise in the standard setting process. We lend our expertise to companies in developing systems and controls to capture and compile information. We lend our expertise in the reporting process that companies do. And at the end of the value chain, we lend our expertise in verifying or auditing or assuring the information that companies provide to investors and other stakeholders. So IFAC's sort of long-term stance is that corporate reporting would be enhanced. What Anne talked about, how much of the value of a company can actually be found on the balance sheet or the income statement that the company files, right? So corporate reporting would be enhanced if we had high quality, decision useful, sustainability related information that answers a lot of the intangible value that is in the market value of companies. And we have been a strong advocate for what Anne and Granville have already been talking about, which is the International Sustainability Standards Board. In full disclosure, I worked for 9 years for the Ifrs Foundation, which is the oversight body of the International Sustainability Standards Board. And the importance of that is once a standard setting process is more rationalized and harmonized, it's the accounting profession that's going to have to take those standards and translate that into the kind of high quality, decision useful information on sustainability topics that are currently, what's done on financial information, right? And that's what Anne's talking about. So that's our role, the accountancy's role in the ecosystem. And there's a huge ecosystem that supports financial reporting. And it's not just the flip of a switch. That means that ecosystem is going to be available to support sustainability-related information. So there's a lot of work to be done. So last thing I want to say is, we've kind of jumped to where we're wanting to get to. And maybe to lay a little bit of background as to why we need to get to where we want to get to. So last year we did a global study. We looked at 1,400 companies in the G20 nations plus Hong Kong and Singapore. And we looked at what companies were reporting with respect to ESG, where and how they were reporting it, and how much of it they were getting verified. So we found that there's a lot of information. 90% of companies report something, even if it's just one greenhouse gas number. Only about half of it, 51% last year, is assured. That rate has gone up now that we've taken a look at another reporting year. What's interesting is that 70% of companies use multiple standards or frameworks, not a single global standard, not just what the SEC would require. They use multiple frameworks for reporting that information. So imagine if we did that for financial information. We use US GAAP, we use a little Mexican GAAP, we use a little this, a little that. We use 5, 7, 10 different reporting structures and frameworks for putting together a balance sheet and income statement. So that just doesn't make any sense, no more sense for sustainability information than it does for financial information. And we need to get sustainability information on par with financial information. So there's a long road to hoe. The data still shows that we have an alphabet soup. And initiatives like what the SEC is doing on climate, what the ISSB is doing on climate and more broadly, and so far no one's mentioned Europe. There's a huge initiative on the continent, the European Union, which has come out with a very robust set of draft disclosure requirements. Those 3 initiatives, among others, are really significant, and we've got to, as stakeholders, as investors, as companies, as policymakers, as regulators, try to find a way to encourage alignment amongst all of those initiatives.
Great, yeah, the great convergence. And I'm curious actually how long that took in financial reporting to get to where we are today, where it is efficient and streamlined. Can you give us a hopeful?
So it was, you're testing my memory, right? So I got into this business in 2010, and it was sort of ongoing at that time. So, I would say at least a decade to do that. And obviously, the FASB sets standards, US GAAP for companies here in the United States. The Ifrs Foundation, the IASB, throw another acronym out there, sets standards for financial reporting that are used by about 140 companies around, or countries around the world. But there was this 10-year plus convergence process where the FASB and the IASB worked very hard to get their reporting requirements as close as they possibly get together. So, we're in a good spot with respect to financial reporting. India and China are two large jurisdictions that are not using, obviously, US GAAP or IFRS standards, but they too have gone through a convergence process. So in financial reporting, the world's in a pretty good place. We need to get there for sustainability information.
Great. Yep. We will, I think, go skip over Nate for one moment and just to ask a little bit more about, we're all kind of working on the standards consolidation and talking about that a lot. But while we're working on that, there are a lot of companies that need to report on this, a lot of tools and solutions coming on the market, and some other stakeholders like exchanges. So Randall, I would love to hear a little bit more about NASDAQ's role in the ecosystem and how you're supporting companies navigating it.
Yeah, so we kind of have three different roles that are related but distinct. We have a regulatory role that we play, and certainly we've had governance standards for decades, and obviously got a lot of attention this last year with board diversity disclosure proposal here in the States, and I think that it comes quickly that an issuer, either new public issuer or longstanding, wants to be aware of their responsibilities toward all their stakeholders, and certainly look to the exchanges to help that, whether us or others. I would say that we also have an interesting responsibility toward the intersection between investors and companies, and so operating an exchange and sitting at that intersection means that when we think about disclosure and thinking about making sure that we make good marriages in our market operations, that we think about how this information gets to the right folks at the right time in the right format so that good decisions can be made. And we spend a lot of time thinking about our stakeholder matrix there, about how we have that responsibility beyond just governance per se, to making those good connections. And then, as you say, we, I think, share a lot of idealism around, getting to a single standard, whether that's an international standard or otherwise. We're just not there yet as an industry, and we have software that's predicated on the fact that we're not going to get there by the 4th of July. And so, when we think about the raters and the rankers and the frameworks, when we see consolidation occurring, we actually see equal and opposite dispersion and proliferation of, specific subject matter questionnaires that are going out. And so our job in One Report is a software tool to help companies manage, get assurance, get disclosed information out, and that's really because we know it's going to be a little past the 4th of July when we...
David tells me we have a decade, but I think we've already passed that.
No. End of July.
But I think that the important thing is when we think about it, it's how do we make sure that there is not any additional sand in the gears when it comes to disclosure, whether there's consolidation or not consolidation. We want to make sure that there's no friction in the system for disclosure. And so we announced an acquisition last week related to a company in Montreal that does KPI-driven disclosure, because about 35% of the companies we work with actually create their own metrics. They're not satisfied disclosing only the items that are in the frameworks by the raters. They want to do incremental disclosure, and that's really reflective of the fact that their stakeholders want more, want different, want a special way to sort of view these companies. So those are the three areas that we are excited about helping our corporate clients to get to a better place.
And I think, of course, speaking of companies, I would love to hear from Nate. Nate Hurst has served in Senior Sustainability and Chief Sustainability Officer roles at the likes of Walmart, HP, and Wells Fargo. So would love to hear a little bit more about the company perspective and how, especially how companies should think about disclosure, maybe beyond a compliance experience, and how they can really actually internalize it and drive changes.
Yeah, I think one of the biggest challenges I've seen in the companies I worked for and working, across, the retail and finance and technology industries is how do you utilize all this work and data that you're collecting? And there's a lot of people, across these organizations working on it tirelessly year upon year. I mean, you end a reporting cycle and it seems like a week later you're starting a new one. But really focus on how is that data leading to real change, right? Management decision making, real strategy change, real business decisions. And I don't think we do a good enough job as a company. And also, I don't think there's enough push from the outside asking to see that decision making and that disclosure being done. So putting a lot of data out there. But the whole point of this is to drive change and make the planet a better place, and to figure out a way to do it in a way that the business continues to sustain themselves and realistically grow, right? I mean, they're in the business of doing business, so they want to grow and create profit. But I think drawing that out more and then rewarding companies and celebrating success when it does occur. We do that in the financial space all the time, right? If someone has a good quarter, we're quick to talk about it, or if they don't, quick to talk about it. And I don't know that we stop and take the time to really understand, okay, what did this report say? What did this data say? Good, bad, or otherwise, and create the space if companies are being more transparent on the, hey, we really don't know how to do this, or we're finding things that aren't so great, but we're still willing to disclose it, that we have the safe space to kind of collectively, all of us across, this panel and around the world and in the room here, to sit there and go, this is a real challenge that probably not just this company, but many others like it are facing. Here's an opportunity to innovate, to create a new business, to create a new solution, some of what the work you're doing at NASDAQ and others are doing. And it feels inside a company like you're a little bit of a hamster on the wheel. And yes, there are new disclosures and there are new requirements coming, and you obviously want to make sure, and there's a big part of the company saying, well, before we sign up for anything else that isn't required, let's make sure we're meeting, these new requirements coming at us, or staying on the front line of that next wave coming. But we're losing the opportunity to think of sustainability and what this data is telling us in an R&D aspect. I think inside a lot of these companies across these industries, you have, where you've really seen innovation and great breakthroughs is in that R&D space. And how do we ingrain this data in R&D in the future to kind of innovate through these challenges and change the way we're doing systems currently? Because we can all agree that has to happen, and it can't happen quick enough, right, to get to a net zero 2050.
I'm curious, well, first of all, we'll turn it to the audience, but then I might come back to you, Anne, to ask about your thoughts on some of that, on how to understand the corporate disclosures, basically, and if you're really seeing the information you need to understand the challenges, the successes, and how you approach that as an investor. But any questions from the audience? I would love to welcome those if there are some. Okay, we have one hand up here. We'll get you a microphone, actually, if you wait just a moment. Thank you.
This may be a question more for Anne, I'm not sure, but wondering about sort of taking things up a level from an investment perspective. So you talked about issuer sustainability disclosures at the sort of the company or that kind of base level. When you take it up a level and you look at, for example, investment products offered by companies like Franklin or others, and comparing those, so that have portfolios of these underlying investments, what are you seeing out there as far as standardization of disclosures at that level, so that if you've got a Franklin ETF and a Vanguard ETF or something like that, that you can kind of compare those on an apples to apples basis?
Well, sorry. So I'm just having a little bit of trouble getting my screen back. That is such a good question. I mean, often when we're talking about these issues of transparency and accountability, it obviously comes into the corporate sector. But the question for the investment world it is just as important. And I think that we've seen, I think a few years ago, it was probably considered important to make, the statement, the commitment, signing up to the PRI, for example. We will integrate environmental, social, and governance into our investment process consistent with our fiduciary duty. I mean, there's $120 trillion of investment money out there which is signed up for that. So then the question is, when we get round to the particular products, how does a customer know the label on the tin tells you what's inside? And this is where we're back immediately into the aggregate confusion, to use the MIT term again. The aggregate confusion means, I think, the same challenges that companies have been having, and also stakeholders and civil society and customers and employees on all sides. Investors are in the middle of this uncertainty as well, So the regulatory side of this is complicated and it's moving ahead quickly. I mean, you all are familiar with the European framework, which is really intended to put these standards and definitions and disclosure requirements, not forcing any investor to say you must do this, but if you have clients who are interested, so you're required to survey your clients, they care about these things, you then have to be able to demonstrate and document how you're actually matching up to those claims. Now, that's one thing going on. Nobody will have missed last week that the SEC, under routine mis-selling rules, issued its first fine in response to concerns about greenwashing. Now, last August, they issued a risk alert saying they're going to be examining the claims that investment managers make on the issue of labeling, but also looking at issues like proxy voting and what happens there. So I would say that, this really means there's a shared interest, both companies and investors, and of course, Franklin Resources is a listed company in the United States, as well as being a very large asset manager. So we've got an interest in making sure we're fully committed to this on both sides, both on the corporate side as well as across the portfolio. But I think the investor community, with the regulatory scrutiny, we all saw, the raid on the office of another fund manager by the German regulator last week as well. Regulatory scrutiny is going to stiffen the spine of the financial community on this one to realize, guess what? Sauce for the goose is sauce for the gander. So whether you think you're a goose or a gander, these issues about transparency and accountability, standardized reporting and so forth are just as important for the investments that are being sold to the general public via advisors or being pitched to asset owners on the institutional side. So this is why I think the framing of this session, to me, is so important, which is actually what do investors and companies do in partnership? Because both sides need to get this right. And it's as much a business issue, I think, for the fund management world as it is for the corporate side of the table.
Are there any other thoughts on that from?
Yeah, I just want to, Anne makes a great point about the necessity of, investors. And the EU's has got, significant proposals, actually existing regulation now, that put meaningful disclosure obligations on financial market participants.
And the SEC's just, sorry to interrupt, Granville, I should have said this as well, right on the heels of that first fine for mis-selling on ESG credentials that the SEC issued. It's just published and there's a 60-day comment period underway. with new reporting requirements in the United States as well for investment managers on this topic. So, sorry.
No, that's great. So, but thank you for that, because the point is that the reporting obligations that Europe and now the SEC are imposing on investors, they can't do a entirely fulsome job without more complete disclosure from issuers, from operating companies in which they invest. And while the quest for standardization is understandable, and this relates to something that both Randall said, you can't standardize everything. And that's why SASB took the approach of creating 77 industry-based standards. What you can do is you can articulate and identify material drivers of value on an industry basis. It is difficult for investors to be able to disclose accurately in what their prospectuses are going to invest in for particular products, and what their overall environmental or social impacts will be if they don't have that kind of industry-based information from the companies themselves, because they just wouldn't know otherwise. And so the companies and the investors do need to work together through organizations previously like SASB, now like the ISSB, to agree what these standards ought to be that will lead to better disclosure. So I know that's sort of a complicated dance that I'm describing, but that is how this system is ultimately going to come together. Randall, did you say 35% of the companies that you guys are working with? So 35% of his companies are saying the industry-specific stuff that we think is relevant isn't being called out by the frameworks. Those companies, presumably, are identifying things that matter to their business. And they know their business better than anybody else does. And it shows you why industry-based standards really are going to be the foundation of disclosure going forward.
I think one of our conversations earlier was talking about the proliferation always, the consolidation, the proliferation. So I think we're always butting against that, trying to standardize, but then finding that actually then you need to separate out to the industries.
The consolidation we are doing, right? So SASB is going into the ISSB, the Climate Disclosure Standards Board, your sister organization, is going into the ISSB, the WEF IBC metrics. So we are taking chess pieces off the table, but the actual substance of the disclosure, you can only standardize so far. You've got to focus on industry-specific stuff.
And does anyone think there's anything really missing right now from the table? I know there are so many metrics out there, and you mentioned that industries are finding new ones. So how are we kind of collecting those to continuously develop them? And maybe that's more of a question for you, Granville, but how are we tracking what we're still missing? And do you think anything's missing currently?
Well, this is a shameless plug for our due process and our comment period. So tell us what we're missing. I mean, truly, without being glib about it, standard setters like my organization and all the securities regulators, they need to hear from the regulated community, the investors and the companies, about what they think is missing. Because regulators and standard setters can make informed judgments, but without the perspective of the users of the information and without the perspectives of the generators of the information, it's only going to be so good. So the optimal product, the optimal process of identifying where the gaps are actually comes from the market.
Speaking of the market, go ahead.
Oh, sorry, I was just going to say as well that the SEC is committed to coming forwards with human capital management reporting standards. And in all the talk about climate risk, we are missing out on people. And if we don't make the climate transition people-centered, it will fail. And we can see that because of political backlash. We can see it through the impact on vulnerable communities. So although the SEC is approaching this on a thematic basis, and Granville's absolutely right about the sector, relevance is going to vary. But human capital management has really not been given the attention it deserves, and it's equally important and it's equally necessary to financial returns. So we're looking forward to that. And of course, it has to be jurisdiction specific, because what you find out about the workforce in Denmark is going to look very different to what you find out about the workforce in the United States. So we've got to have jurisdictional tailoring as well as the sector-based approach.
Yeah, and I think, Anne, that human capital reminder is critical and a wonderful note to maybe end on. So I would like to just thank all of our wonderful panelists again. And I think we heard a lot about the consolidation underway, and hopefully that gives some of us hope in the audience and some of the companies that are working on this. And yes, I would just like to thank you all again. Thank you so much for your time. Thank you all for joining us. And as we get down from the stage, I'll invite Philip Cornell on stage for the next session. So.
Thank you.
Thanks, everybody. Bye.